Hello and welcome, everyone to another interactive session on our live webinar series, Moneyfy Mantra, where we speak with, industry experts on various personal finance topics, to help our viewers on empowering them to manage their personal finance more efficiently. So, I was just going through some studies, over last 2, 3 years, some of the results were 66% of the millennials have not started savings for their retirement. And to give you some perspective, millennials are now 20 years to their retirement. And large part of these millennials who have started saving, they don't know where to invest, or they are not investing as expected. So we have seen last 2 years where in many of these millennials who had their jobs see their savings erode because of various lockdowns, delays in their salary, pay cuts, etc. Now that everything is back to normal, it is the time to get back to planning for the future. And on the same lines, our discussion for today is on millennials, stepping into financial independence. And to cover the topic today, we have Mr. Joseph Ollukaren from Aditya Birla Sun Life AMC. Joseph, a very warm welcome to Moneyfy Mantra.
Thanks, Harsh, and welcome to all the viewers. Thanks a lot for having us on this call.
So just to give you a short introduction about Joseph, Joseph currently heads, the equity products for Aditya Birla Sun Life Mutual Fund. He has over 15 long years of experience, and he's worked with, various asset management companies in India. So now, before we jump on our topic for today, let me give some details of our app Moneyfy by Tata Capital, which offers complete suite of investment products, financial products, 100% digitally. One can start investing, through mutual funds. They can start an SIP. One can open a small case account. Open their NPS account for their retirement, or apply for loans or insurance products. If you want to, download Moneyfy, we have given the link on the description below. Do subscribe to our Tata Capital's YouTube channel to get the latest update on our products, and to get live updates on the webinars that we are conducting. I would also request all our viewers, if they have any questions, to post it on the comment box. We will take it towards the end of this session. So yeah, Joseph, over to you.
So thanks a lot, Harsh, for a very warm introduction. I think as you know, it become a part of the way we have been dealing during pandemic. Webinar has, I think, opened new doors in terms of a very convenient way of dissemination of information. And I think going in that same fashion, I would just share the presentation with all of you and then maybe take it forward from there. So as the name rightly suggests, it's about the millennial stepping into the financial for financial independence. And I think the first up question that we had thought about was, why should I look at mutual funds over direct stocks? The temptation is always there. You always hear about this stock has gone up considerably over a short period of time, and hence it becomes first stepping stone to that extent for a lot of young investors going in. And I'm here not to discourage that, but having said that, I think one needs to understand the associated risks with it. And if one is intending to take up direct stock itself, then what all parameters you should have looked at or checked in. So I think one of I list down these questions where one needs to understand that, do we have that large investable surplus to spread your risks? Now if you look at a stock which is today current, there would be a lot of stocks, and I'm not naming any stock, but it varies from starting maybe 50 paisa or so and going up to 50,000 and beyond. So one investor, if he's investing even in one stock of 50,000 and buys one single stock, I think it kind of concentrates the risk, and that is where the first question that one needs to ask is, how large is the investable surplus? The other very pertinent question is, it is a very small timeline, or, we are busy with our work, day-to-day activity. Uh, and hence, do we have that kind of time to track it? Because, it's a very, very fast evolving market, and we see that changes happen very suddenly. And if you're not in front of the screen and are not able to trade, you might end up being in red as opposed to being in green, which was the initial thought. Uh, Again, it has to have a larger theme. If you're investing in few stocks, it provides you some amount of diversification, but I think it still doesn't play on the whole theme of it. uh, and the bedrock of all of this is to ensure that there is a certain amount of wealth creation that is happening. So I think, as it's said, before running a marathon also, and I think the seasons are around the corner for marathons, it is very important to do the warm up. And I think that warm up essentially happens via investments, which helps you take this journey in a little more disciplined manner. It sinks into your long-term goals. And I think, as Harsh had suggested, the general age group is there, where there is enough and more time for us to look at investment and creating wealth. Now, I just share a couple of more slides. How do professionals manage it? I've been very closely associated with the CIOs here as well and elsewhere too. And basically what they look at is a host of information to come out with a particular portfolio. So, for example, there is a fundamental research that goes in, there is valuation analysis, they look at the amount of risk that they're taking on a portfolio, and subsequently they also look at technical analysis. So there are too many parameters, as you can see, in terms of evaluation for a single stock or a portfolio of stocks that goes in. And this is done by a group of people to be able to create that kind of portfolio. So individually, if I were to do today investment into a single stock or a group of stock, it will still be very difficult for me. So to have a trend analysis, look at it from a macro level. Where is the economy going? What screener should I put to take out certain stocks? There is a channel check that is done. That is, for example, if you're looking at auto companies, so you go back and check with lots of distributors as to how the ground pickup is there. And if there is a ground pickup, maybe you will think about various other facets to include that particular stock in your portfolio or not. And then there is, on top of this, there is a third party research that they have that help from, right? So huge set of analysts who are on the sell side also assist the investment team, and then they are able to filter this through, reject certain ideas, and create a portfolio. So while it looks interesting to have an investment in direct stocks, I think as you're warming up, it is always prudent to have a larger portfolio in mutual funds, and then take steps towards having a direct portfolio to complement what you have as a mutual fund portfolio. So, as an investor, what do you do and what is your requirement is the first question that comes up. Now, I think it's safe to say the first is the return parameter that investors look at. There is the other parameter that they look at is safety, liquidity. I think tax efficiency, while a lot of people may not necessarily think at this time, but I think it's also something that helps enhance the returns pretty well. And I think uh, as you said, there are two things that you're very certain about. One is tax, and the other is death. So you're not anyway going to evade tax per se. So I think these are the four parameters which an investor looks for from a particular investment. Whether it is in bonds, real estate, gold, or equity, it still gives you that kind of question. Now, I think what we would like to do or help is that, if the age group is between 25 to maybe 35 or 40. What we are trying to say is that uh, the time in the market helps, and the amount of time that one spends, the power of compounding helps to multiply that money at an exponential rate, and that we will showcase during this presentation as well. So if you see here, it's a very simple assumption that is being made, where we're taking a SIP, which an investor does, a systematic investment plan, on a monthly basis of 5,000 rupees. We kept the rate of return constant. The period of investment varies. So if you are disciplined, less disciplined, and took some time to get your house in order, the period of investment varies from 30 years to 20 years. So if you see the difference in the total invested amount, it is a mere 6 lakh from the guy who invested for 20 years to a guy who invested for 30 years. But look at the difference in final value in terms of what that asset has done over this period of time, and that is the power of compounding. So from 1.75 crores to 49 lakhs, the difference is nearly 3x. And even if one were to do a slightly higher amount of investment, for Kamlesh, for example, if it's not 10, if it's not 5,000, it's 10,000. Even then, it would be very difficult to catch up for somebody who starts late. So I think the first paramount importance for savings or investing is that you allow that kind of time for your investments to grow. The other question that comes is, set of questions that one needs to ponder over while you're creating your own portfolio is, what is my financial position? What are your income and expenses? How much is that you can invest every month? And define your goals and give priority. It's always prudent to have an emergency and retirement fund. And I think what is more important than sacrosanct is to ensure that you abide by what you have defined. So as you start investing and you have answered these questions, you have defined goals. Post that, once you start saving and investing, the very important part is to stay invested through and through. So I think this is a basic fundamental factor. You invest for your short-term needs, create an emergency fund, and don't use any other goals. Once you have created your emergency fund, you look at how and what is your asset allocation going to be. And I think, as a thumb rule, what generally is said is 100 minus your age should give you your equity allocation. Now, the idea is that you stay invested for a long time. So assuming that one is 30-year-old, the overall portfolio allocation towards equity funds should be about 70%. Remaining, you have your emergency funds that you have created, cash in hand, and certain other liquidity, short-term goals that you would have. That 30% can be put in for those assets. The other parameters that one needs to look at is, what is your overall risk-taking capability and how do you behave when the markets are volatile? And how often would you like to rebalance the portfolio? So I think it's prudent that one looks back and sees what they have invested in, how the investments have grown, and then take a stock whether it needs to be rebalanced or not. But I think at a very primary level is, what is your risk-taking capability? And that kind of tends to give you that alpha and help you generate that kind of reward and wealth over a period of time. So this is where we articulate that what is your own ability to take risk, what is your willingness to take risk, how much each asset you are defining as to how much time that you require, what is the objective and goals that you are looking at, and not necessarily timing the market. And I think that is where people lose out their money, and then they kind of fear coming back into the market. And this is just for a to give you an example in terms of on both fixed income as well as equity, what is the risk return parameters. So from the lowest risk fund for your emergency funds, you would start with maybe an overnight liquid fund, which goes up to all the way up to debt oriented hybrid funds, which has very small minuscule amount of 15 odd percent of equity exposure built into that. And similarly, you go into equity side of investment, where you will essentially look at equity savings fund up to sectoral funds. So you have your equity oriented hybrid, large cap, diversified, mid cap, small cap funds. And as you see the risk is increasing, the percentage return also increases. So it is as simple as it gets. The higher the risk, the higher the return. And it's not necessary that the returns may come in immediately. So what we've done here, it's a very busy slide, and I think what we're trying to indicate is that over a period of time, there are different asset classes, and within the asset class, there are varying subclasses which tend to perform suitably well in given. So each financial year, each calendar year, if you see, there is no one constant guy who's at the top. It could be gold, it could be fixed income returns, it could be equity, small caps, and so on and so forth. So what we're trying to say is that it's prudent that you have allocation across at the breadth of across the spectrum of investment, and that kind of gives you that kind of solidity to your portfolio to make sure that you are able to withstand that kind of volatility. Now, if you have risk return parameters, and this is where we picked it, if you have short term returns, the investment is made for a short term moderate investment in moderate risk, which is your hybrid kind of funds, and subsequently in investment in your, depending on your age and your what your long term goals are, then you have allocation to higher risk products. So if you have to look at how to map your financial goals, and I think very short, medium, long, and very long is where we have classified it. And between that time frame, we essentially look at possible goals which you can have. As we said, there is contingency plan, there is places where you intend to park your windfalls or bonuses, and then take some time to allocate it back. If it's a short-term vacation, a down payment of a car, some corpus that you want to park aside for now, where you're not able to decide which equity product is good, or you're sitting on a fence, it helps you to park these funds into fixed income assets, mutual funds. And I think in terms of a long term, where your goals, and I think maybe currently not necessarily all of them would be there, but I think a dream house, a dream car, or going on a world tour, such aspirations essentially require a little more planning, and it's been generally shown, and hence it is prudent that you have a mix of diversified equity mutual fund in your portfolio with small cap and sectoral mid cap flavor to give you that kind of fillip to your overall return percentage. So a combination of large, mid cap, flexi cap, and small cap, along with a dash of sectoral funds for an equity standpoint, will help. And I think there is Moneyfy, which will always help you in terms of being able to filter this down in terms of which are these 5 to 7 funds that you need to look at from an equity allocation perspective. From a debt portfolio standpoint, I think what you need to do is essentially 2 things: understand the credit quality of your portfolio. If it is AA plus and above, it's a good portfolio. And I think what you need to do is all of these are comes with defined timeline investments. As long as your timeline duration matches with the investment overall, it helps and becomes easier. So if it's a up to 1 year, you can look at a money market fund. If it is yet shorter duration, up to 3 months, there are ultra short term funds which are available, and that is where you can park that money for that period of time, and hence let your money also generate a better return compared to the traditional assets that we generally keep our money in. And I think tendency from an investor standpoint is that when the markets become volatile, the first thing that comes up is whether it's on news portals or pop-ups that I see on my phone. It's like end of a world, kind of a scenario where it's like the market crashed by 1,000 points, and I think it would have happened as recently as day before yesterday, and it's up today again. Those 1,000 points. So I think it's very important to look and not forget what your larger long-term goals are, and intermittent volatility, how it helps you. It may be also a good point in time to constructively enter into the market and increase your overall equity weight as and when the opportunity is being provided. Because if you're doing an SIP for say 10, 15, 20 years, you already started accumulating, and the rupee cost averaging is doing that job for you. So will the power of compounding at the end of the tenor. But I think these dips are where you would try to move more asset towards equity. And why we say that is that I think the overall growth story for India seems to be intact, and it's one of the better placed markets today in the world. People also have this tendency to move from equity to debt when the market becomes volatile. There is panic redemption if there is news, without getting into the nitty gritty of understanding, consulting it with somebody who has more knowledge. The first thing is that you see the portfolio, and today maybe back in the days it was not so easy, where if you had to track the portfolio you had to make more effort than how it's available on a phone today. So I think the amount of action that it requires, the temptation to control your own self from doing all the things that have been listed up is quite a task. I think it's more behavioral in terms of wealth creation, and discipline is of paramount importance, and that becomes very important. I think where every nanosecond you get a lot of information, you need to understand what is that information on which one needs to react to and one needs to act on. And I think the act on has to be thought through prudently. So I think this basically, in a nutshell, explains the concept of rupee cost averaging, which sits at the heart of an SIP investment, where at varying periods of time, you will have different cost of purchase, and it will average out and hence give you a slightly lower cost price. And when you go to the market to sell the same product, the profit percentage would essentially be higher. So I think from a rebalancing perspective, the portfolio which is tactically allocating, that you have shorter term goals, is something that you need to review more frequently, while something that you look at from your longer term goals is something that you keep more have faith when you invest and stay put with the investments that you've done. So I think how I summarize is you create an emergency fund first up, important. And I think what we have seen during this pandemic, that it kind of helps you tide over any issues that one can face. Have an asset allocation plan and stick to it. Step up SIPs where you've been constantly continuing with your SIP. Like every year we see an increment in our salary. Similarly, our savings should see a step up in that. And there, this is the feature which we have built, where you have a step up SIP where you can buy a denomination of 500 or upwards, can increase the SIP percentage. And I think we need to have more control over our emotions in terms of redemption, and look at portfolio rebalancing. And I think at this hour, I think I may just like to conclude with something which may have a closer connect with you. I was just going through, this movie buff that we all are. So I just thought, the RRR movie made a lot of money in the market, and everybody was very gung ho about it. And I think I just sat back and looked at it, and I said, okay, this team has been together. They've done RRR. Before that, the team director Rajamouli and others had done Bahubali 1 and 2. So I said, maybe it's just an extension of that. But back in 2012, they also came up with a movie which was launched in Telugu, which was called Iga, and its remake was made in Hindi as Makhi. And that is where the team had essentially come together to create something. And every incremental stage that you see, they have done better and better, because there is some amount of ethics that goes in, and comfort that comes. And I think that is something that one needs to look at, as to how the long term investments and faith in your own capabilities and investment would take you to create immense wealth for you. So I think investors need to stay focused, and I think we can, Harsh, if the time is permits, I can answer questions from here on.
Sure. So just a second. Yeah. So I think we have some questions, and the first question which I have, millennials today are struggling, to buy a house, paying off their education loans, end up doing multiple jobs over time for covering their expenses. And more critically, average wealth of millennials have gone down, over last few years. What is your message to these millennials, to walk towards the path of financial independence?
So I think first up, Harsh, it's encouraging to see that there is certain amount of responsibility which they've already taken at a very young age. Whether it is taking an education loan and then repaying it for a brighter future. I think that being said, the responsibility at the other end is also to ensure that at times it is tight, but I think in terms of the flow, cash flow, and you're trying to make amends. But I think discipline is at as a cornerstone, and I think what we've been told for so many years is that you take out that investment stroke savings first from your salary, do the savings, and then subsequently look at having an expense there and thereabout. So I think what it does is it gives you a limited budget, and that's where you can say, okay, this is what my money for spending is. But if you spend upfront, then I think the saving or investment would not happen. So while I understand, and housing is something that one should look at a slightly later age. If you're just out of college, you're doing your first job, you're maybe 2 years into the job, buying a house should not essentially be your priority. It's maybe, stepping stone is to create that kind of down payment, that as and when, you are capable enough, you have met some of your liabilities, then you are able to extend that loan. The capacity of taking that loan also increases, and your liability also goes down, because you will be able to finance some part of it. So I think saving is very important. It has to happen first, and then the spending needs to happen for all of us, whether it is millennials or non-millennials. And I think that is a rule that we need to follow, which will help, in long run.
Correct. So, I have one more question. So, which is that one category of mutual fund you will recommend? So, because we see a lot of new users coming on our platform and starting to invest for the first time, they get caught by some of the other thematic funds, or some decisions that they make, that which leads them to believe that equity investing is very risky.
Right.
So what would be your recommendation for such individuals who are starting to invest for the first time? Which category of mutual funds that they should go for?
So I think, very good question, Harsh. And I think in the whole process, I was not able to spotlight this, but I think flexi cap funds as a category should be one of the investments that the investors should look at. The other is a large cap fund. Now, these are, relatively stable, stronger funds. Large cap companies generally tend to navigate the volatility better, and hence give you that experience of good returns, or lesser fall in case the market is falling. That is the key. I think today what happens is people chase past performance and then invest. So maybe, in a period of a year or 2 years back, as we seen that IT was booming, so the returns were compelling enough for investors. They saw the last year 1 2 years returns, and they invested in a sectoral fund first up. And that is where, you burn your fingers, because the story, the momentum that we had seen in IT sector per se, was waning, right? There was a lot which was happening in the sector, but because it was a 2 year back performance which was reflected, we have seen a lot of investors coming in and buying IT sector funds. So first up, I think very important to build a solid portfolio, where flexi cap fund will invest across. The fund manager will take that call, how much allocation needs to be done to large cap, how much allocation needs to be done to mid cap and small cap. And generally, if you see in flexi cap as a category also, the small and mid cap portion is taken to a slightly smaller extent, so that the volatility is lesser for the investors who come in. And large cap is, first up. You put in money first up in a large cap fund.
Fair enough. So we have one question from our viewer. He's saying his investments value go down, and obviously the month has been slightly more tough for the equity investor. So what would be your message for this investor?
So I think, and this is where, the discipline and overall thought comes into picture. So if, for example, I have not so much information, but the question being that if it's for maybe, uh, a fund that I've invested in with an objective of 3 years, to maybe make a down payment on a car, I think I'll stick around with it. If the investment is in an SIP mode, I'll definitely stick around. Even if it's in a lump sum mode today, I think what is happening is we are seeing global uh, repercussions on India much more than what essentially India. So internally, if you see, we look at all the numbers are good. Corporate earning rates are good today. Our tax collection, which is indicative of what consumption is happening, that is also good. So indicatively, the lead indicators are suggesting that, this is indicating that, we will have a good 3 to 5 years from here on from an equity standpoint. So I think you stay put, is what my message would be, and stick to the investment rationale that you had in terms of. Now, if it's a sectoral fund or a thematic fund, then I think maybe one needs to revalue or reassess. But if it's a slightly diversified fund in which the investment is, and I think you will tide over this current volatility that is being witnessed.
Yeah. So you had covered rightly that there are two ingredients to making wealth or achieve financial independence: time and money.
Right.
while many of us would not have that high amount of money to invest. But the power of compounding with time will, help individuals to accumulate wealth, and that is where the time comes into picture. So, how long, should one, or how much years before one should, start investing to achieve that goal? So if that goal is about retirement, so what is the time period, before which one should start saving or investing for that goal?
So I have over the years had classic interactions with a lot of people, right? So I think when I look at my parents' generation, they were least bothered about retirement of their own because they knew they were in government jobs, so they knew that there is a certain somebody who's going to take care of their retirement, and they were equally concerned about my retirement because I'm not working in a government setup, and hence we have to create our own corpus, and that is where I think as is I showed it in the presentation as well, that the longer time that you give for your investment, even if it is a very small amount, is 1,000 rupees, so for example, in some of our funds, if you had invested at inception a lakh of a rupee, the compounding has been enormous. You have 34x compounding over 20 years. And that is the kind of wealth creation or value accretion that happens for investors if this give that investment that kind of time. And that is the cornerstone. And I think it's not about money. When I said money in my presentation, it was when you're doing a direct stock investment, so then you need a larger corpus. While for mutual fund investments today, I think minimum is 500 if you're in ELSs, or a maximum of you can start with 1,000 rupee SIP also. And I think that 1,000 rupees month on month will give you that kind of effect when you look back, and it doesn't pinch today. If you have to go to a decent restaurant, a meal for two or four, I think the bill may be essentially slightly more than $1,000. But and I'm not discouraging people from doing that. It's something that one needs to do. But I think that value of that 1,000 rupees over a period of time of compounding of good accretive investment is immense, and that is where one needs to stay put. And even small amount of 1,000 rupees a month, 2,000 rupees a month just keeps building that bucket, and you will see wonders that it does at the end of period where you are looking at some tangible output.
Correct. So yeah, I think individuals need to plan early the better. Okay, so one last question. I think there are a lot of individuals, while it is prudent to not make mistakes, and not recommend products which are not suitable. But nowadays millennials get caught on get quick rich schemes. There are a lot of unregulated products in the market, and everyone is promoting them, and they are creating a lot of noise, and that's where the retail individuals get caught. So do you think it is worth going for such products? That's the message we would want the millennials to understand, and learn.
So I think one of the basic parameters for investing also is that where when everybody panics is where you should invest, and when everybody is getting greedy is where you should not invest. And I think that these are all simple sayings, but when it comes to implementation, I think we find it very difficult to do this. But if you follow this simple rule, I think you will be able to make money. uh, and yes, there are times where it seems very lucrative and difficult. You have that fear of missing out, right? Today I think that is of paramount importance. So that discretion I leave, but I think to the investor. But I think the larger set is that it is a period where people are becoming greedy about something. It's something that you need to ponder intuitively about. Is it something that everybody is going to become rich by investing in such a instrument, or is there a merit in looking elsewhere today for me to look at, which is something which is value accretive and will have that kind of return potential later on? So you have to differentiate your fads, whether it's fashion or investment. I think there are certain periods of fads that keep coming in. There are different assets which come up, promising or showcasing in a short period of time the kind of returns. And but generally I think it is not that simple to build that kind of wealth. It has to have a disciplined approach to it. So I think, as I said, where there is greed is something where you turn away from. Where there is everybody is selling is where some value can be always seen.
Correct. So yeah, that was rightly answered. So yeah, I think we come towards the end of the session today. Joseph, it was an extremely insightful session for our viewers. Thank you for your time to conduct this session. I personally hope the video is seen more and more millennials, to help them understand the concept of investing and starting early. So a message to everyone, in case you are looking out to start investing into mutual funds, we have Moneyfy app by Tata Capital to help you with that. You can open your MF account within minutes and start investing. Thank you all for listening to us, and have a great Navratri. Thanks.
Thanks, Harsha. Thanks a lot. Thanks a lot for having